In the high inflation world we find ourselves in, people have been asking us what exactly they should invest in to best protect themselves and their money. We've talked up some options in the past like gold and fixed income investments, but what we're going to dig into today are some awesome stocks that we think will flourish in a high inflation environment.
The stocks we'll be talking about today are all dividend stocks. If we look back at history, in the 1940s and 1970s, when inflation last surged, dividends accounted for 65% and 71% of the S&P 500's return, according to Fidelity. The same research shows that when stock prices have struggled in the past, as we may be about to experience, dividend stocks have rescued investors' portfolios. Stock prices in the S&P 500 fell during the 1930s and 2000s, but dividends almost completely offset these declines.
These studies looked at America's S&P 500, as do most stock market studies, but the same market forces surely hold true for UK stocks. We're picking our dividend stocks from the UK's FTSE 100, since UK stocks are not subject to the crippling dividend withholding taxes seen on US and many European stocks.
Also, the FTSE 100 is famous for its dividends, expected to yield a tad over 4% in 2022, with the dividends paid growing by 2% year on year and dividend cover across the FTSE set to improve, all according to research by AJ Bell. But with these stock picks, we're aiming to do better than the FTSE 100 average. Indeed, we must if we're going to beat inflation. So what are the best stocks for the job? Let's check it out.
All of our research for the stocks in this video was made possible through our subscriptions to Stockopedia, the premium stock screening and analysis tool. If you want to try it out so you can build your own epic portfolio, you get a free 14-day trial when you go there via the Money Unshackled offer link. It's really worth checking out if you're serious about picking stocks. Even better, the same link will give you 25% off your subscription fee if you decide to keep it.
Why these dividend stocks fight inflation. Before we jump into the stocks, we need to sell you on the theory. After all, we hope you don't invest in something just because an influencer tells you to. Here's why dividend stocks in particular are well placed to keep your portfolio up during the troubled months and maybe years ahead.
Looking again at that Fidelity research, during periods of high inflation, stocks that increased their dividends the most considerably outperformed the broad market in terms of total return, on average by 3%. The report's author said that based on history, if high inflation is here to stay, I believe dividend growth stocks look likely to outperform.
Another reason that dividend stocks in general have an edge over other stocks during high inflation is that inflation reduces the value of future profits, while cash paid out to you now is received before inflation can erode it. In other words, cash now is worth more than cash later. And in the case of many growth stocks, like those in the tech sector, later might not be for years or even decades.
And then there's the fact that companies which pay high dividends tend to be profitable and have excess free cash flow, qualities that may help them during these challenging times. Fidelity says this is an especially big deal today when the market has an unusually large proportion of unprofitable or marginally profitable companies. 12 FTSE 100 firms are currently forecast to offer a yield of more than 7% in 2022. 5 miners, 2 tobacco companies, 2 house builders, 2 financials and 1 telecom stock.
Best of the miners, Rio Tinto. There's a big choice of high dividend paying mining stocks in the FTSE 100, but one stands out from the crowd. Rio Tinto is one of the world's largest miners, unearthing essential and highly valued resources, including iron ore, diamonds, gold, copper and uranium.
The company has joint headquarters in London and Melbourne, where it is also listed on the Australian ASX stock exchange. Its operations are truly global, however, and if you like the sound of a multinational company that knows how to consistently make big profits and shell out dividends, then look no further.
Let's dive into Rio's finances and see what's so great about this stock. Rio Tinto's share price has been a stock on the rise since November, and the stock is gathering momentum as it climbs higher up Stockopedia's stock ranks as a super stock. Its forward price earnings ratio is 8.5, which might sound cheap, but for its industry it's pretty average. The EV to EBITDA though, which is a more complete version of the price earnings ratio that factors in debt, is just 3.8, making this stock ridiculously cheap.
The cheapness of this stock may explain its incredible dividend yield, which is forecast to be 8.3% based on the current share price. A stock's dividend yield moves in the opposite direction of its stock price, all else being equal. For instance, a stock starting with a 2% dividend yield that loses half its stock price overnight would now have a yield of 4%.
A very high yield then may in fact be reason for caution, and we get suspicious if a stock is paying dividends much higher than 6% and so requires further investigation. Dividend stock investing is not just as simple as chasing yield. That said, Fidelity's study also showed that the best combination of returns and risk lied in the 7th, 8th and 9th deciles of stocks ordered by dividend yield. A decile represents 10% of all stocks, with those stocks with a higher yield towards the right hand side of the graph. Risk is shown by the green line and total returns by the blue bars. A high yield was good, just not too high a yield. For those stocks in the top decile with the highest yields, the risk shot up.
Back to Rio then. What else is going on for this stock? Well, its quality and health scores are all in the green. You can see that on Stockopedia, these are derived from metrics like return on capital, which is 30.9% for Rio. You don't need to be an expert stock picker to know whether this is good or bad, because Stockopedia ranks the metrics against the investing universe and colour codes using a traffic light system, so even a simpleton can see how good this is with just a glance.
It also qualifies for 12 long screens, which means it qualifies as a great stock by 12 different investment strategies, about as good as a score as it's possible to get by this metric on Stockopedia. Its revenue is growing strongly as it continues to build up its international operations across 35 different countries. Its earnings per share is flying up too, expected to be up 90% in 2021 when the accounts get released.
Let's look at the meat of this dividend stock by checking its dividend payment record. Rio Tinto has a strong record of high dividend growth over the years. While it dropped 21% in 2016, it's more than made up for that since. In 2017, the dividend paid per share went up by 73%.
Then there was a modest, but still above inflation increase in 2018, and from there it's been insane growth ever since. 34% growth in 2019, 17% growth in 2020, when much of the rest of the FTSE cancelled or froze their dividends, and 2021 is expected to have a 114% growth in the dividend payment.
High dividend growth rates are one of the main things we're looking out for now, as it has a particular relevance in a high inflationary environment. What we want to see is our dividend stocks increasing the size of the dividend paid per share by a percentage that's higher than the rate of inflation. It's the reassurance you need that you'll be protected from inflation. Inflation is above 5% right now and expected by many to climb to at least 6%.
So when we see that Rio is expected to increase its dividend payments not by 5%, not by 6%, but by 114% while still keeping a dividend cover well over 1, needless to say this stock is giving you great protection against inflation, helped by its positive exposure to commodity prices such as iron ore, which has nearly doubled year on year. Even if the dividend falls by 36% for the 2022 financial year, which it may not do, forecasts are notoriously unreliable that far out. The 2 years combined are still combating inflation several times over. Just look at the 2022 number compared to 2020. And according to AJ Bell, Rio Tinto is expected to be the FTSE 100's biggest dividend payer in 2022, despite this forecasted cut.
That's about it for this stock's financials, other than to point out that it has negative debt, meaning it has more cash than loans. It has current and quick ratios well above the healthy ratio of 1, and its sales and earnings per share are not just good, but among the best in both the mining industry and the entire rest of the market. Contrary to the average analyst consensus of 21 investment banks, we're saying that this is a strong buy for any lover of dividend stocks. In fact, I liked the look of Rio so much that I've just added this stock to my portfolio.
Big Tobacco, British American Tobacco. British American Tobacco is the largest cigarette maker in the world based on sales and is present in most countries. One of the key reasons for owning a tobacco stock is the economic moat created by the company's products being addictive. It means that rightly or wrongly, their customers aren't going anywhere, so your dividend is very likely to keep coming in.
Moreover, BAT has an incredible forward dividend yield of 7% and is cheap as chips with a PE ratio of just 8.8. It's saddled with debt, but we think the addictive nature of this product again helps to keep this debt manageable.
BAT has been carrying over £40 billion of net debt since 2017, though this has been decreasing as they've paid it down and its profits have been increasing. Its interest cover is nearly 7.5 times, meaning it can very easily afford the interest payments, and its dividend cover has remained comfortably over 1 throughout.
BAT looks like a great dividend stock for normal times, but especially so now because of its epic dividend growth history, which remember is perhaps the most important metric in times of high inflation. Just 16 companies in the FTSE 100 have increased their dividend in each of the last 10 years, and BAT is one of them, growing their dividend on average by 6.6% a year over the last decade.
I have owned British American tobacco stock personally for the last several months, and I'm sitting on an 18% capital gain plus epic dividends, despite the wider market being flat. BAT is expected to grow its dividend by 5.3% in 2022, making BAT, in our view, one of the best stocks to beat inflation.
The wild card, DCC. There are so few stocks right now that have high yields and high growth rate, and whose other fundamentals we find acceptable. In fact, we can only find 2 that ticks all these boxes, and they're the ones we've just discussed. But this next stock, DCC, has such good growth that it may turn out to give even better protection against inflation.
Its yield is borderline acceptable at just under 3%, but its inflation-beating dividend growth rate is epic. DCC is there in AJ Bell's Dividend Heroes table, with an average dividend growth rate over the last 10 years of 10.2% per year on average. And this epic growth is set to continue, with 8% rises forecast for both 2022 and 2023.
Part of the reason why we think DCC will be able to withstand the incoming tidal wave of inflation is due to what it does. It's heavily involved in the sales, transportation and logistics of petroleum and oil, which are essential commodities for the day-to-day operation of supply chains across the UK and Europe, which made up 71% of its profits in 2021. Businesses cannot help but have to pay these costs. They are not luxuries that can be cut back on.
If you've never heard of DCC, it's because their customers are mostly commercial, industry and retailers, and DCC are mostly occupied by moving fuels from A to B. They're tucked away way down here on the FTSE 100 index at number 68 by market cap, which is just £6.2 billion.
It's a cheap stock with growing revenues and little debt, and if it can keep growing its dividend per share at the rate it has been for the last decade, then an investment into this stock now at today's prices could reap big dividend rewards in the future. Share prices tend to follow the dividends too, so maybe there is also decent capital growth in this stock's future.
Question of the day: what stocks are you investing in right now? Join the conversation in the comments below. Thanks for watching! On this channel we talk a lot about personal finance, investing in all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.